February is just around the corner and talks about the union budget are picking up. Now, the union budget isn't just a bunch of numbers. It's the government's plan for managing our country's money. And it's just not for economists or policy experts, it affects everybody. Whether it's tax changes, fuel prices, or welfare programs, this document shapes the way we live and work. Now, when budget day comes closer, we're hit with a lot of confusing terms like capital expenditure, tax buoyancy, fiscal deficit, and more. Now, it can feel overwhelming. But what exactly is a union budget and why does it matter? What is the fiscal deficit and how is the government managing its finances? What challenges does the Indian economy face right now? And what were the key highlights of last year's budget? And what can we expect this year? In this video, we will break this down for you. And as a bonus, we'll also talk about how the stock market usually reacts during the budget season. Now, let's break it all down in simple terms. Let's begin. You're watching Informed Investor, initiated by Equentis. Now think about how you manage your money at home. You start by figuring out your income, your salary, side gigs, or money someone owes you. Then you look at your expenses, rent, groceries, electricity bills, or maybe saving for a holiday. Now imagine this on a much bigger scale. Instead of grocery bills, think of government spending on programs like healthcare and education. Instead of borrowing from a bank, picture the government raising funds from financial markets. Now, the union budget is essentially the country's financial plan for the year ahead. It's like the central government's playbook for managing income and expenses, covering the financial year from April 1st to March 31st. In simple terms, it's a detailed roadmap of how the government plans to earn money and where it intends to spend it. Now, let's talk about how the government earns money and how it spends the money. Now, the government earns money in two main ways, revenue receipts and capital receipts. The revenue receipts is like the government's regular income, money it earns without having to borrow or sell anything. Now, a big chunk comes from taxes, which are of two types. Direct taxes, the money people and businesses pay directly, like income tax, which is what you pay on your salary, and corporate tax is what companies pay. Now, indirect taxes are taxes you don't see directly but pay when you buy stuff, like GST on possibly everything you buy, custom duties on imports, and excise duties on products like petrol, diesel, and alcohol. Now, non-tax money is the extra income the government makes. For example, it charges interest on loans it gives to states or public companies. It also earns dividends from its share in public sector companies. Now, think of it like the government being a shareholder and getting a cut of the profits. Now, coming to capital receipts. Now, capital receipts is the money the government gets from selling things or borrowing. If the government sells a part of its stake in a company like LIC or Air India, the money from that sale comes here. Also, if someone repays a loan the government gave them earlier, that's part of this too. Now, do know that the government spends more than it earns, so it has to borrow money to make up for the shortfall. Now, for this, it issues bonds and promises to pay back with interest later. Now, to put this into numbers, if the government earns 1 rupee, about 19 paisa comes from income tax, another 17 paisa comes from corporate tax, 18 comes from GST, smaller amounts like 5 comes from excise duties, and about 4 comes from custom duties. And borrowing makes up the largest chunk, which is about 27 paisa, because the government often needs more than it earns. Now let's talk about how the government spends its money. Now, just like we have expenses like rent or groceries, the government spends on different things too. About 19 paisa goes towards paying interest on loans it took earlier. And about 21 paisa goes to states as their share of taxes. Total of 24 paisa goes to central government schemes. About 8 paisa is spent on the military and security. And things like food, fuel, and fertilizer subsidy cost about 6, and about 4 goes to pension, and the rest covers miscellaneous expenses. Now, you've probably heard terms like fiscal deficit, fiscal consolidation, fiscal glide path thrown around, especially during budget discussions. Now, let's break them down and understand why managing them is important. Now, when we talk about fiscal deficit, we're basically talking about the difference between how much money the government spends and how much it earns in a given year. Now, think of it like a personal budget. If you spend more than you make, you're in a deficit. Now, just as we discussed, the government too spends more than it earns, so it's in a deficit. And it also borrows money to cover the gap between its income and its expenses. Now, if the government's fiscal deficit is really high, it can cause problems. Increased government borrowing can crowd out private investments because it reduces the availability of funds in the financial system, leading to higher interest rates. Now, borrowing to finance a fiscal deficit also increases the government's debt burden. As we just saw, a large portion of the government's budget goes towards interest payments, reducing funds available for development projects like infrastructure, education, and healthcare. Now, credit rating agencies also monitor fiscal deficit closely as a measure of economic stability. Now, a high fiscal deficit can lead to a downgrade in India's credit rating, increasing the cost of borrowing for the government and businesses. The persistent high deficit also signals weak fiscal discipline. Now, this can also deter foreign investors who might view the economy as being at risk of instability. Now, to deal with this, the government needs a fiscal glide or fiscal consolidation path. This is basically a plan to gradually reduce the deficit over time, making sure it doesn't get out of hand and hurt the economy in the long run. For example, back in 2021, the fiscal deficit was about 9.1% as a percentage of GDP, which was much higher than expected because of all the extra government spending due to the pandemic. But since then, the deficit has been coming down little by little. For 2024, it was reduced to 5.6%, and for 2025, it's expected to drop to 4.9%, which is still a projection. However, do note that historically, the fiscal deficit as a percentage of GDP was much lower. Now, in a recent report, rating agency Carriage projected that the centre's fiscal deficit for fiscal year 25 will be at 4.8% of GDP, slightly below the budgeted estimate of 4.9%. Now, in short, a fiscal deficit tells us how much the government needs to borrow to make up for its spending, and the fiscal glide path is the plan to reduce that borrowing gradually to keep the economy stable. Now, let me quickly walk you through the highlights of the Union Budget fiscal year 25, which was held last year, presented by Finance Minister Nirmala Sitharaman. Now, this was her 7th consecutive Union Budget, and this budget also happened to be the first full budget of the Modi's government's 3rd term. Now, one of the major updates was a change in tax rates, which directly impacted investors. The short-term capital gain tax was increased from 15% to 20%, while the long-term capital gain tax went up to 12.5% from the earlier 10%. However, the government also raised the exemption limit for LTCG from 1 lakh rupees to 1.25 lakh rupees per year. On a brighter note, the angel tax was abolished, which was fantastic news for startups. This move was expected to drive a surge in innovation and entrepreneurship. Now, the new tax regime, which focused on simplification, was another highlight. No tax was charged on incomes up to 3 lakh rupees, and the rates increased gradually, maxing out at 30% for income above 15 lakh rupees. Now, the standard deduction for salaried individuals also went up from 50,000 rupees to 75,000 rupees. Pensioners also saw relief with deductions on family pensions increased from 15,000 rupees to 25,000 rupees. Now, the government also prioritized capital expenditure, which is spending towards infrastructure and development projects in a big way. They allocated about 11.11 lakh crore rupees, which is about 3.4% of GDP. Now, as we discussed, the fiscal deficit estimate for fiscal year 25 was also about 4.9% of GDP, amounting to about 16.13 lakh crore. Now, what stood out was the government's commitment to fiscal consolidation, aiming for a deficit below 4.5% by fiscal 26. Now, this balance between growth-driven spending and fiscal discipline was a reassuring sign. Now, the budget also included targeted allocation for several states. Andhra Pradesh received about 15,000 crore rupees for its capital city development. Bihar got 26,000 crore rupees for highway development, about 11,500 crore for flood disaster relief, and about 21,400 crore for power plant. Now, let's talk about what's happening with the Indian economy. Right now, we've hit a few bumps in the road. If you've been following the stock market, you've been probably noticing those dips in the Nifty 50 and Sensex. Now, while India's long-term growth story is strong, we're facing some challenges right now, both from within the country and globally. So what's going on? The biggest issue we're dealing with is slowing economic growth. Now, India's GDP growth rate dropped to about 5.4% in the July to September quarter, the lowest in almost 2 years. Now, some experts say this might be as low as we can go, but there's still a concern that the slowdown could drag on longer than we would like. Now, to make sense of this, let's break down what drives our GDP, or in simpler terms, the economic growth. Now, think of GDP as a combination of 4 engines. Private consumption is the money we spend on daily life, eating out, buying gadgets, going on trip. Now, this is the biggest piece of the pie, making up about 62% of our GDP. Investments is what businesses and the governments invest in, like building factories, buying equipment, or infrastructure projects, which adds value to the economy. Now, investments account for about 31% of GDP. Now, government spending is what the government spends on things like roads, schools, and hospitals. And net exports is the difference between what we export and what we import. Now, India imports more than it exports, so this part of GDP often has a negative impact. Now, here's the problem. 3 out of these 4 engines are slowing down. Now, people are spending less, which is hurting private consumption. As you can see on this chart, private consumption grew 6% slower than the 7.4% seen in quarter 1. Now, companies are also not investing as much, so private sector capex hasn't seen a strong recovery. Now, investments component has also slowed to about 5.4%. Now, exports are struggling due to global uncertainties. Now, only government spending has grown after a poor show in quarter one, but even here, government spending in the first half of the fiscal year is much lower than the previous years. Now, globally, we're also hearing about a potential trade war, and the global economy is slowing down. At the same time, the rupee is weakening, which could make imports more expensive and add to inflation. To sum it up, inflation is eating into what people can spend, private companies aren't investing in new projects, exports are slowing due to global headwinds, and corporate earnings have also taken a hit. Now, the government's latest numbers suggest India's economy will grow at 6.4% in fiscal year 25, which is slower than we would like. Nominal GDP growth might also stay below 10%, which creates additional challenges for the upcoming budget. But keep in mind, these are still early estimates and these things could change. However, we've also seen some few silver linings recently. Industrial production grew by 5.2%, especially in manufacturing and consumer goods. GST collections have been strong, and so have automobile sales. Now, a strong harvest from the Kharif and Rabi season could also boost rural demand. So, while the challenges are real, there are some pockets of hope. Now, let's talk about what the upcoming union budget could focus on, especially given the challenges our economy is facing right now. Now, the government has a tightrope to walk here. On one side, they need to be fiscally responsible, basically not overspend. On the other hand, they can't completely hold back because the economy needs some fuel to grow. Now, let's not forget that private consumption makes up about 62% of our GDP. When people like you and me spend less, whether it's eating out, buying gadgets, or upgrading our homes, it puts a big dent in the economy. Right now, this engine is struggling because of inflation and slow urban demand. Now, if the government puts more money in people's pockets, it could give consumption the boost it desperately needs. Now, another area that's dragging its feet is private sector investments, or what we call private capex. Companies are holding back on big projects because consumers are spending less and they're feeling cautious about expanding. The budget could step in with incentives to encourage businesses to loosen their purse strings and start investing again. Now, exports have always been a smaller part of our GDP, and now they've taken a hit from weaker global demand. Now, the rupee's depreciation is a mixed bag. It helps make our exports cheaper and more competitive, but also raises the cost of imported goods, which isn't great for businesses relying on imported materials. The government might also look at ways to support export-driven industries, especially those heavily impacted by rising input costs. Now, government spending is one of the few engines still running, and even this is slowed compared to last few years. Employment generation may also remain a focus area. The government should keep its focus on schemes for better employment opportunities in the country, given India's demographic dividend, something that markets are very excited about. So these are the things that we think the government might focus on. What do you expect from this union budget? Do let us know in the comment section. Alright, let's talk about how the markets move around the budget. Now, January is always an interesting time for Indian markets because this month brings a mix of quarterly earnings announcements and, more importantly, sets the stage for one of the biggest events on India's financial calendar, the union budget. Now, naturally, the stock market reacts to these announcements, and let's just say it, it's often a roller coaster of volatility. Now, if we dig into history, we can see that January has consistently been a volatile month as investors start speculating about the union budget. And 2025, no different. Everyone's watching closely to understand how the government's fiscal measures might shape the country's economic outlook. Now, let's take a step back and look at how the markets have behaved on budget days over the last 18 years. Now, out of those 18 budgets, the market saw negative trends 10 times. The biggest drop was a sharp 5.8% fall in 2009, and on the flip side, 8 sessions were positive. But here's the kicker. Now, even though budget day can be turbulent, the markets usually recover. In fact, on average, the market delivered a 1.46% return in the month following the budget. So what does this tell us? The union budget often sparks mixed reactions, sometimes highly positive, other times negative. Now, predicting how the stock market will react is tough, but there's a pattern. Budgets perceived as pro-growth and business-friendly, and adhering to fiscal discipline evokes a positive market response. Now, let me give you some examples of the budget that really moved the needle. First, the legendary 1991 budget. Manmohan Singh presented a reform-driven budget that effectively ended the license Raj and kicked off economic liberalization. Now, as a result, market jumped 5% on budget day and soared about 27% in the following month. Fast forward to 1997. P. Chidambaram introduced a game-changer tax cut, reducing the maximum marginal income tax rate for individuals from 40% to 30% and for companies to 35%. Now, this too spurred a positive market reaction. And more recently, we had the 2021 budget, which struck a growth-oriented tone. Highlights included privatizing 2 public sector banks, boosting infrastructure, and raising the FDI limit in insurance. The markets loved it, rising about 5% on budget day. But here's the thing. Past performance does not guarantee future results. The stock market is influenced by a host of factors, and its reaction to the budget depends on a lot of moving parts. But pro growth, consumption driven initiatives tend to lift market sentiment. Looking ahead, market movements will depend on these factors: bringing down the fiscal deficit, whether there's a consumption boost in the budget, inflation and interest rates domestically, global factors like Trump's policies, the US Fed's interest rate decisions, and of course, the Q3 earnings. So while the union budget is important, it's not the whole story. It's like one chapter in a much larger book. So stay calm, stay focused, and keep the long-term picture in mind. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.